Hello, my name is Shrans, and today we are going to cover a company that comes from an industry that is very important in our lives. You might have also used the products, but you wouldn't know that these products have been made by this company, right? But before we start, please remember this is not investment advice. We're just trying to understand the financial performance and position of the company. And the company is, if I remember correctly, the largest pharmaceutical company in India by revenue. The name of the company is Sun Pharmaceuticals, so it manufactures and sells different medicines. It also makes APIs, which are used in the manufacturing of medicines, and it also provides research services. And all of these works are conducted across different therapeutic areas related to heart diseases or nervous system or other areas as well. All right, so let's first start with the financials of the company. Right now, if you look at the financials of the company, you'll figure out that on an overall basis, the revenue growth has been quite strong. It is up 5.7x. But unfortunately, that revenue growth hasn't translated much into the EBIT and PAT growth. So EBIT is up only 2.8x and PAT is up only 2.1x, right? So revenue CAGR is 21.4, EBIT CAGR is even less, only 12.3, and PAT CAGR is even less, which is at only 8.5. So on the revenue side, good growth, but on the profitability side, it's slightly challenged, right? Now let's look at the items of the cash flow statement. So if you look at cash flow from operations, good here, and on an overall basis, it's the growth here is somewhere similar to EBIT, and the cash conversion is also very strong. So if you look at the CFO, which is slightly lesser than 44,000 crores and comfortably over the PAT of 35,000, somewhere above 35,000 crores, right? So in that sense, the cash conversion has been good. CFO understandably is slightly more volatile at different places, but on an overall basis, company's cash conversion is strong, right? Now, talking about investing activities, investing transactions. So, as you can see, there have been consistent outflows in all the years. And these are not just investments into the fixed assets, but the company has also carried out significant investment transactions, right? When the company has additional funds, so it places them temporarily into deposits and then sells them as well. So, those transactions are also there apart from the usual investment into fixed assets, right? And this is something that you can see here in non-current assets as well. They have continuously kept on increasing, and in fact, they're up 7.8x. Not all of them are fixed assets, but yeah, a majority of them are fixed assets that are used for the productions and servicing as well. The cash flow from financing. So if you look here, the companies has had more or less outflows only, and these outflows mostly related to dividend payments, but there have been borrowing transactions as well, especially in the recent years. And from the looks of cash flow from financing and also from the looks of the liability side, I was able to understand that these are related to short-term borrowings more rather than the long-term borrowings, right? So this is something that you can also this is something that we can understand if we look at the balance sheet position as well. So dividend has been paid in all the years, but also borrowing transactions here and there, especially in recent years, issuing borrowings and then repaying borrowings as well, right? Now coming to the balance sheet items, equity very healthy growth rate. So equity is up 4.8x, which is a growth rate of around 19% CAGR. Current assets have been increasing slightly, lesser than revenue. So on that side, the management has been good. Non-current assets have consistently increased. That is what we've already seen. Now the current liabilities is what we were talking about, right? So if you look up till here, then the numbers were very small, right? But then here it's just gone up from 6,000 to 16,000, an increase of almost 10,000 crores. And since then, it has stayed in this range. And since the company has borrowing transactions as well, but the non-current liabilities, if you look at here, these are very insignificant, right? And that is why in the cash flow statement also there were continuous issuing in 1 year and then repaying in the next year. So I thought this might be related more to short-term borrowings in the company, right? And non-current liabilities, as you can see, these are very insignificant, so to speak. Okay, now let's quickly look at the growth of the high-level financials. So if you look at revenue, so very strong growth in these 4 years. So from 2011 to 2015, these are very good years from the company. But after that, it has not been that good. So very low growth here, decent here, again a degrowth here, and then very not the best of growths here. So if you compare actually this year, FY17, 31,300 crores of revenue, and FY20 is only 32,838.40 crores, right? So from FY17 to FY20, it hasn't been the best for the company, right? EBIT and PAT, again, if you look at that, similar story that is going around in EBIT and PAT as well, but the growth rates are slightly lower, and overall also the growth is slightly lower. PAT is understandably volatile compared to the profit, but on an overall basis, cash conversion is good. Equity has gone up more or less straightforwardly. Again, in the recent years, it has not been the best case, right? Assets, continuous reinvestments into assets. When you talk about the non-net working capital, which is the current assets less current liabilities, so it has more or less the trend has been similar to revenue, but not exactly similar in the essence that there seems to be a change in the working capital policy with the short-term borrowings and things like that, right? But I mean, the current assets are sufficient to cover the current liabilities, right? And the liabilities have been increasing and decreasing because of taking borrowings and repaying borrowings, and then also short term borrowings and other stuff like that. But liabilities are very on the leverage side, the company has a very comfortable position, so to speak. Return on capital, if we talk about, now this is where we find a lot of interesting things actually. So if we talk about the return on capital, so from this year up to this year, in fact, in the 7 years, FY11 to FY17, if we look at the return on capital and return on equity, they followed a very good trend, so to speak. And in fact, they peaked out in these couple of years where the both return on capital and return on equity were at their maximum, but after that they started declining. But till this point they were still very healthy return ratios. But in the recent 3 years it has just fallen down, so from 22 to 10% and 19 to just 5.5 or 6%. So they've fallen drastically in the recent 3 years. And if you look at that, it has been driven a lot by the margins. So if you look at the margins, up till these 7 years, the margins are very healthy. It's the PAT margins are mostly about 20%. EBIT margins are around 30, 35, even 40% in some years. But after that, in these 3 years, again, they've just badly fallen, right? From 27 to 15, from 22 to 8%. So this seems to be a problem. And this is not just really related to, additional depreciation due to expansion or something like that. If you look at the breakup of the P&L, you'll find out that it has a lot to do with normal operating expenses and also production related expenses as well, because gross profit margin had also fallen. So this seems to be a slight issue for the company, because in the recent 3 years, neither the return ratios nor the margins have been on the bestest, on the better side, right? Talking about the other aspect of return ratios is asset utilization. So asset utilization, I think, has broadly been maintained in these 10 years. So if you look at the capital turnover, it has the median is 0.73, and the for asset turnover median is 0.52, and the range is also more or less not very diverse or not very volatile. It has been operating in that sort of range, in the for capital turnover around 0.7, for asset turnover of around 0.5. These are not probably the best ratios if you could look at the other pharma companies as well, but at least from the company's perspective, these have been stable. Asset by equity, which is the financial leverage position, very comfortable, so to speak. It has never gone above 2x. Most of the liabilities are actually short term, which are easily covered by the current assets. And on the long term side, on the non current liabilities, there are hardly any. Cash conversion, we've talked about it, very solid in most of the years. Actually, the CFO is comfortably greater than PAT. In a few years it's lower, but then that is something understandable. Net cash flow, if we talk about it, and on an overall basis, so there are few years in which there has been a net cash inflow. There have been few years in which there have been a net cash outflow, especially in the recent years, right? But from what I could gather about the company is generating good cash flow from operations. It is able to reinvest into the business as well, and it is able to pay out its shareholders dividends as well. And this is something that we'll again see when we look at these on a cumulative basis. Current assets is less current liabilities. So, I mean, there's been a sudden increase since here. Till this point, these were slightly lower, but then again, these have gone up quite a bit. And if you look at the CAGR of current assets less current liabilities is 11.8%, right? But comfortable liquidity position as well, because the company has short-term borrowings. So it is important that the company has short-term assets as well in order to pay those. Non-current liabilities to equity, I mean, this seems very insignificant. There are hardly any non-current liabilities. All right. Now let's just take a quick look at the net cash position. So a total of around 44,000 here and around 26,000 in cash flow from investing outflow, and an outflow of around 17,000 in cash flow from financing. So if you look at these, then the company is more or less, able to cover its investing and financing flows from the operational flows, and which seems like a good sign, although the company is slightly struggling for growth at the moment. But on the capital allocation side, this seems that the company is generating enough funds of its own to grow and to pay out its shareholders. All right, now let's quickly wrap up with the highlights. So strong revenue growth, which is up 5.7x, but poor growth in EBIT and PAT. So, and I think this is more or less also a function of how the margins have shrunk in the recent 3 years, right? So CFO is greater than PAT in 8 out of 10 years. Cumulative CFO, as you can see, is comfortably greater than the cumulative PAT, right? Significant investments, non-current assets are up 7.8x, and consistent dividend payments by the company with few borrowing transactions, which I think are short-term rather than long-term. Right, decent growth in equity, right? It is up 4.8x, so good growth there, and very comfortable leverage position because there are very few non-current liabilities. Mostly there are short-term current liabilities which are comfortably covered by current assets. Return on capital greater than 20% in 6 out of the last 10 years. Return on equity greater than 15% again in 6 out of the last 10 years. But what's the problem? The problem is that both of these three have been below median and have been on the lower end of the spectrum in the recent 3 years. So that's a challenge. EBIT and PAT margins have drastically declined in the recent 3 years. So in the first 7 years, they were quite healthy actually, but in the recent 3 years, they've just fallen apart, right? Asset and capital turnover have broadly been maintained as we talked about it. So from the asset utilization perspective, the company is able to, maintain that scale and maintain that utilization even as it significantly scales up, because the revenue has gone quite a bit up and also the non-current assets have also increased quite a bit. But from the asset utilization side, the company has been able to maintain the efficiency of its operations, right? Company has been continuously reinvesting into assets, paying dividends, and maintaining excess cash as investments, because there have been a lot of investment transactions, selling and buying in the same year, and then also it has some balance of investments as well. So on that side, the company is able to generate funds and allocate those funds as well. So what's the conclusion here? The conclusion here is I feel that the company has strong financial position, strong historical performance as well in terms of growth, in terms of returns, in terms of margins as well. But currently, the recent 3 years have been below average growth, right? And poor performance as well in terms of margins and in terms of return on capital as well. So at this point of time, the company seems to be slightly challenged. It will be interesting to see what happens in FY21, and if the company can, bring back its sort of golden years that were there between, FY11 to FY15, or sometime even if you could extend it to FY17. So these initial 5 to 7 years were very strong. Recent 3 years, not so good. So we'll need to wait and watch how this company's financial performance goes into the future. So that is all that I had to share about this company. I hope you found this helpful. If you have any suggestions or any questions, please comment below. The link to the Excel sheet is available in the description. If you want to receive updates about this and so much more about investment research, please subscribe to the channel, and you can also receive updates on WhatsApp using the link in the description. Thank you so much for watching. I'll see you again with another company.